ACC reported a decent set of earnings in the third quarter of 2021 on the back of modest volume growth across its key operating markets. Operational performance surprised positively as margins held firm despite cost headwinds. ACC reported revenues of 3,749 crore rupees in Q3 CY21, a growth of 8% year-on-year, mainly driven by an improvement of realizations as the cement volumes came in largely flat at 6.6 metric tons. Operating margins held firm despite commodity price inflation across the board and came in at 19%. EBITDA stood at 712 crore rupees. Buoyancy in demand across rural markets and resumption of infrastructure and road projects supported cement offtake in the quarter gone by. Overall, volumes were driven by southern markets. While the central region was stable, the demand in eastern markets took a minor hit due to rains and cyclones. Recovery in metros and Tier 1 cities led to healthy growth volume in the ready-mix concrete segment that surged almost 50% on sharp recovery in construction activity across metros and Tier 1 cities. ACC's margins benefited from higher realizations and supply chain efficiencies, but cost inflation remains a cause of major worry across the industry. In Q3 CY21, raw material costs were higher by 13% and power and fuel expenses rose 26% due to unprecedented surge in coal and petcoke prices. Freight costs, however, were flat owing to several cost-saving initiatives. Network optimization, lead, and geo-mix improvement mitigated effect of steep rise in diesel prices. Under Project Parvat, the management has initiated several cost-saving initiatives to improve the economics of operations. The execution remains on track as the commencement of the 24 megawatts waste heat recovery systems should lend some support to margins in 2022. In January 21, the company commenced commercial production at its Sindri plant, having 1.4 metric ton grinding capacity. Further, the capacity expansion work at Ametha and Tekaria is underway and is expected to complete over the next 18 months. As cement volumes are largely tied to infrastructure and housing spends, the business resilience in the past couple of quarters underpins a positive outlook. Moreover, the financial impact of COVID is fading and the economy continues to gather momentum ahead of the peak cement demand season. On the cost front, the business is facing stiff headwinds as the availability of petcoke imported coal remains a challenge and poses a significant threat to production and margins. Given balance sheet strength and strong market position, we continue to retain our positive stance on the business despite concerns surrounding the economy and industry. The stock has rallied more than 40% YTD and is trading close to its 52-week high. In terms of valuations, it is now trading at 11 times CY22 EBITDA, and investors should therefore wait for some pullbacks to accumulate the stock with a long-term view.